a weekly chart of the NASDAQ. All right, so we have had our economic news driver come out at 8:30. Whenever we have that report or similar like PPI, CPI, non-farm payroll, you shouldn't be trading that day. You should just wait for the opening bell and usually trade the 10 o'clock silver bullet. So if you're really forcing yourself to engage on that day, just wait until the silver bullet. But I want to take your attention to this low right here. Okay, so on this candle here, on the weekly chart of NASDAQ, I believe that low, it could touch it because we have this sell side imbalance, buy side inefficiency. We're just about near it here. So how far can it keep pressing up into it? That far and as much, but I don't have a whole lot of faith in it as of right now. But the midpoint of that wick right there, which would be consequent encroachment. I like the fact that we had the candle close on this weekly range off of its low. The next week we open, we trade up, come all the way back down. So from this candle's close and this candle's low, all of that range is balanced and all the way back up to here as well. So I like to see some kind of stiff opposition to any forward run higher. It doesn't mean it has to go to that level. It just means that, in my opinion, using a higher time frame, broad range observation, vantage point, I think that that's a likely scenario. If we look at the daily chart, we can see also we are just about at the butt end of that candlestick low. So about 10 handles or so, thereabouts. So this big candle up here. So that's also something to look for. So we'll just call it the 854. So 854 should be on your chart and 884. Dropping down to a 60-minute chart, really wonky type of price action in here. Just keeps drifting higher. 15-minute time frame. If you look at the new day opening gap, you'll see that's the high. If we're looking at naked price action, which we're going to try to do that today, if we can just bring in the 5-minute chart here. So we had our 8:30 news driver. It rallies up, challenges the London session high. Okay, so you can see the new day opening gap high that formed last evening right there. Okay? So there is the close at 5 and then reopen at 6 o'clock. And since it's over 20 handles, sticking with the rules, the consequent encroachment level is annotated. So you can see how we traded back down to that level there and then rallied rather aggressively. Order block trades into here, rallies up, and we've pushed above the London high. So now I'd like to see it either try to make an attempt and fail. You can see all the other levels down here. You see all that? So I'd like to see it make an attempt to try to get to that 54 level and or the 84 level. And I'm in no hurry, but for the sake of looking at where it could potentially reach for, I was looking at those higher time frames with you. All right, so all I'm doing is, we'll go 883.5. And that was based, obviously, like I mentioned, on that weekly chart. Then we drop down to the daily chart. The key level I'm interested in on the daily is here, and the weekly is here. Right? So now, opening bell, we want to see if it can spike up into, reach up into these levels here. I want to see how, if it can, trade to that daily level or the weekly level, because they've already pushed it up a lot. I'm not interested in buying long. I'm not interested in going short yet. So I just want to sit on my hands and wait. And what I'm trying to do, Caleb, is since it's post PPI, post CPI, that type of report, in other words, after that report comes at 8:30, we don't ever try to do a initial high, initial low for liquidity's sake, into those types of reports because it's extremely manipulated. There's the daily chart objective to trade to. So now I want to see if we can trade it at 83.50. Initially, what I'm looking at is I like these lows in here. See how they're relatively equal? So I like that one. So we can go and start annotating that now because this is our initial relative equal lows. So I like this. So that's my initial sell side liquidity. So I think this is a factor to study. It goes below this low here. We've already ran through it on the 8:30 news, then came back down into this buy side imbalance, sell side inefficiency. So you might question, well, why don't you just put your level there? Because I'm teaching my son to focus on relative equal lows and relative equal highs. And what I'm doing here is I'm waiting to see if they can form a relative equal high. It doesn't have to. It can go up there where it's at right now and fail and break lower, or it could go up above 83.50 and just keep going higher. I'm not trying to predict that type of price action because I'm trying to build a idea around the 10 o'clock hour. When you have something like this, you screenshot it, and the key takeaways is this. Label it, but you want to go back through price action and say, okay, from where it was likely to reach to and why, and then from that price point here, all the way to the beginning and the origin of the move, which is here, which is the new day opening gap that was formed at 5, and the difference between that closing price and the opening price at 6 p.m. yesterday evening, New York local time. And then you go back through and you study it. So you can see we traded into an order block there. It rallied up. We have a breaker, trades there with a consequent encroachment, buy side imbalance, sell side inefficiency. So there's a convergence of several PD arrays there with the likelihood that it's going to run what? Trades higher, comes back down, trades into the inefficiency here, rallies again, comes back down once more, trades into the rejection block, which is the down close candle closing price, trades there and expands through. Fair value gap forming with an order block, an old high, fair value gap, trades to it, rallies to the daily objective I outlined, and then the weekly. On the weekly chart, we have now traded and closed in that weekly fair value gap, or CIVI. That's this level here. You might look at that and say, well, that was wild. Why didn't you take that trade? Because I'm not interested in chasing a run like this that's long in the tooth. I don't want to try to get in the last portion of a move. You got to remember what's going on. Everyone now sees what the news driver did at 8:30. Okay, so that big run here, they want to try to get on board and run with that. And here's the opening price at 9:30. It's a one-sided, one-shot delivery from open right to the weekly level I just gave you. That's all I would be reaching for if I was going to go long anyway. So what I choose to do is I want to see, do they want to take it there? And then I can sit and relax and worry about what it's going to do afterwards. Because obviously the market's going to gyrate and move around, right? So we have to build some kind of context as to why we're entering a trade. And if it's so close, like if we're in here, yes, 50 handles is 50 handles, but it's chasing 50 handles at the tail end of, what's that, 200 handles. That's the 5-minute chart. We went up to our price level here. I'm going to drop into a 1-minute chart now. Okay, so you can see on the 1-minute chart, we have those relative equal lows, real smooth. I don't like this one because it went slightly lower than that one. If we can get through this and beyond that low, then my next attention would be right in here. See how smooth that is? That's also right before the 8:30 news driver. So I'm going to err on the side of it could be just them pumping it up a little bit more and trying to get traders caught offside chasing it, because it's been going up since last week. I just remembered that I didn't show you what I was referring to yesterday. I said how we can use Monday. If I'm anticipating a 20 to 30% retracement on the present or previous week's range, if I don't get that type of delivery on a Friday, if the candlestick for the weekly range is all one-sided, big bullishness, that type of thing, if it's been predominantly one-sided and last week was up predominantly for the indices, I mentioned in the live stream on Friday, I think it has the potential to do TGIF. But I mentioned yesterday and Monday that we didn't see it materialize. So when that happens, we can use that same idea and use the highest high that forms on Monday and anticipate that type of retracement. You can go and pull up your weekly range, measure your fib low to high, and include yesterday's high, and notice where the low of the day formed. And what also was there yesterday, what I was calling for, last Friday's new day opening gap. So there's a convergence and confluence of Friday's new day opening gap and also the 20% range of that entire, yesterday's high and last week's low. So that's the effect I was referring to. That's why all the factors where I was saying to you, what are you doing when you're trading on a day like this? You got to do it early. It's important to try not to be in a rush after a PPI, a CPI release, because you feel like you're missing the party. This right here is our initial buy side. And you don't really need the PPI and the CPI numbers to get these types of ranges. You just have to hope for the daily range. Over time, you'll learn that. So what I'm studying here is this wick right there. I'm watching the halfway point. Does it spike into it a little bit above it and reject, or does it completely roll over top of this high? I prefer it to take out that high and then start to make an attempt to gravitate down to take the low here, and then work its way down in here. Even if it wants to go higher in the afternoon or continuously go higher, I would favor this type of action simply because it'll give us some framework to work within for the 10 o'clock hour. There we go. You got the run above it. Okay, so now we have relative equal highs after the opening bell. We don't try to do any initial buy side or sell side on PPI and CPI number days. Wait for the opening bell. If we can get the framework within the range of 7 to 9:30, we can go back through that range because they're all operating hours. You just don't want to look at anything prior to 7 o'clock because then you're going to incorporate London price action, which kind of makes it a little bit more complex because there's a lot of different things that can inspire in terms of specific daily schematics, or profiles as I call them, like roadmaps, how the daily range will be formed. It doesn't mean I'm going to know exactly every single day, but there are characteristics that tend to repeat, and I taught that on the mentorship content. So we have had the buy side ran on relative equal highs post opening bell, no run on sell side yet. It's just been one straight shot. Here's 9:30, traded back down a little bit, rallied up, and what I want to do is I want to see if this gap here that we traded back down into, does it give that up? Okay, because if it can fail and go lower, this may be something that's influential for resistance. We're letting the market tell us very clearly where it wants to go. We already shown 50 handle run off of a daily target and a weekly target, straight shot to it, trying to get a feel for where the market could genuinely end without a whole lot of back and forth type price action, where it can try to gravitate to. And that's the draw on liquidity. And that's the first thing that you're trying to do. And when you give yourself permission that that's all you're trying to do, it makes watching price action enjoyable. So there we go. We have a run again. And we'll see, does it want to keep that, or is it just disrupting everyone that's been watching the stream? But the same thing here. If we can trade lower, what happens if it just keeps going up, ICT? Would you feel upset about that you missed it? I don't care. It's going against everything that I have as a comfort. Anyone that's trying to go long in this, and you're literally asking the market to take your head right off. I force myself to wait for it to trade to opposing liquidity and then wait for a failure swing after that, or I look for it to give a clear indication that it wants to go higher after it's gone lower. So it has to go into a retracement that makes sense and goes to a PD array or a liquidity pool that I've already predetermined. So that way I'm not reacting to or impulsive to what it is I see in price. I'm waiting for something to come into my crosshairs, and then when it does, I'm going to pull the trigger. If I'm going to pull the trigger, I expect my target to fall to its knees, not fight me. I want it to just give up the ghost and drop dead. And then I know I have a winner, and I can just manage it and see how much blood I can squeeze from it. Watching where price is right now, it can be rather uncomfortable because, especially if you're new, the natural impulse is it's going to keep going higher. And why shouldn't you just take a long? Because again, it goes against everything that I understand about price action. We opened up after rallying. It's been going higher. We had the 8:30 news driver come out here, came back up. We retraced. We have these smooth levels here. This one here is possible. And right at the opening bell at 9:30, that opening price right there, we opened and then rallied. We came back down, traded into the inefficiency between that candle, and then rallied. I don't want to be a part of that. I'm waiting for more information. And my interest is how we trade at the 10 o'clock hour. I want to see if we can give up this ground that we've made here and try to make an attempt to come back down here and disrupt this smooth little area here. I don't care what it does after that. If I'm fortunate enough to see that unfold and I can outline it in front of you and walk you through it and it delivers, does that mean I'm going to go long or hold for lower prices than that? No, it just means that would be the end of my interest. The exercise would be complete. Remember this gap right here? I told you that may be influential if we fail. We went up to the weekly objective I was giving you. We pierced it, and we pierced it once more. So we have 3 drives here. The 3 drives pattern is no different than anything else, like a bull flag or bear flag. I like to see those things form when I'm opposed to what they may indicate. How do I avoid falling victim to a 3 drives pattern? I'm more inclined to simply wait for the logic that I teach, where I'm trying to focus just simply on what's the next easiest likelihood of where price is going to go next. It's very liberating. And there's a lot of things that are going on in the market today in recent years and months that the market has become faster, and that volatility brings with it a great deal of risk. So you have to know what you're doing. We're in a climate where you have to be very careful and try not to be so 100 mile an hour. Just slow down and look for a nice, easy setup that makes perfect sense to your model, the parameters that you've made for that model, and it fits your personality. So we're in 10 o'clock now. So far, the market's still just pressing higher, and true to form where I was saying, we have a high, higher high, and a higher high. Just because you see 3 drives higher doesn't mean it's going to reverse. It doesn't mean that you're going to get a nice sell-off. It just means sometimes that if the market is heavily manipulated, and that's what we're seeing on a day like this, you can get ground down to dust. The market just keep grinding in one direction. And I genuinely don't like those types of days. And if I can see days that are starting to show those characteristics, it's very easy for me to say, you know what? I'm going to go watch a movie, go read a book. I'm going to go spend time with my wife, or I'm going to do whatever. I won't watch the charts because I want magnitude. I want swings that move around and gyrate. I don't want to be a part of a day that just continuously chips away and just grinds against a direction. I don't like that. I don't like to be in trades, even if I'm right when they do that. I don't like those types of days. So one of the things that you've probably seen over the years when I show examples and I end up in trades where I am seeing profits build up, and it may be a trade that I've built a large position in, pyramiding it. I'm more likely to take a whole lot more partials along the way, because what I'm doing is that I'm managing my emotions and the psychological war I'm having inside my head that I don't like this. Even though it's making the trade more, I don't like being in that type of environment, because those days are harder for me to determine how far it'll go. And because I don't have the patience to just simply hold on to it and walk away, because I'm looking at every fluctuation in price action. I'm crawling in my own skin because this is not what I want to see. I want to see it really start to run and then give me some kind of additional entry point. I'm actually looking for a way to start scaling out of the trade. And there's many times where if I just simply would have just moved my stop one more time, just to be at peace with it, that came back and stopped me out. And I just simply waited till 3:30 and then either take a large portion of the trade off if it's in profit or to simply close it. I would make a whole lot more money doing that. But I can't live with myself while I'm in the trade. What I'm saying is there are certain characteristics in certain types of days in the way the price action is being delivered to us. Even with my concepts, I could be in a winning trade and still not feel comfortable in it. And because of that discomfort, I will actively look for ways to just start scaling out of the trade as it's moving in my favor. And then what will happen is it's many times like this. Later on in the day, it has this parabolic run. And if I just would have held onto the trade, I would have had a huge win because of that. But I'm generally not a part of that run because I've wrestled with the personality traits that I have within me that goes against that. Some days where I'm in it, it's like, should I just close all of it or should I take half of it off there? And if I start wrestling with half or all, then I just take one contract off and I see how I feel about it. Do I feel any more comfort from it or is it causing me more concern? I should have took off more. If I feel like that, then I'll take another partial off as soon as it makes a lower low if I'm short or a higher high if I'm long. Right away, you should be looking at this gap right there and how we left it smooth. If it's going to drop, I would like to see it take it above these highs here and then show displacement below that low. If it doesn't do that by 10:20, my interest is done for the morning enough. But I'm not out there saying trade everything that I teach. And that's the problem with most of my students. They try to do everything that I introduce. And I'm not using everything when I'm trading. I'm picking one thing based on what I think the market's going to do. I have to know what it is I'm trying to do. What is it that I'm looking for? Why should it even be there? And there's a whole lot more to it than just simply saying, I want to trade silver bullets. I'm going to trade, in the macro times. Okay, well, but what are you trying to do? There has to be something, for you to be building the idea around. The only thing that I see viable. And so far we've had just the run above these relative equal highs. So we have that. It would have to go below here because it's relative equal lows. It also would be a much more meaningful displacement. I don't want to just use this one. I want to use this low here. So I want to see if it can trade below that, maybe a little bit of retracement in there. And then we'll study and see if it wants to make an attempt to get down into this inefficiency and maybe even challenge this going into the lunch hour. Watch this level in here. Now I'm shading that. It should technically be orange because I want to see, can it fail? I want to see it trade below it, come back up and find stiff resistance on it and try to retrace into the daily range. That's what I want to see. If it's ever this color, I'm expecting it to be an inversion. Whereas we see it here become a buy side imbalance, sell side inefficiency, and it trades back down in. If we were having a retracement and it traded down below these lows here and it did something like that, then I would look for it to go higher off of that. But because we've been one-sided, this keeps pressing higher, 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 higher. We created relative equal highs and then we upset it like I was outlining that. I'd like to see that happen. Then I want to see it reject. It just seems like they're trying to punish anybody that wants to be short and they keep knocking them out. And then when there is no more sanity in trying to go short, that's when the market will go lower because they are building liquidity when you do this. And I wouldn't feel comfortable trading at 9:30 waiting for the market to create just this little bit of a little tail. That's the low of the day. Can it form like that? Sure it can. I'm more inclined to say, okay, let it rally, let it buy chase it, then break down, take out some liquidity here. And then if it wants to start going higher, then I'm okay with that because we went to a discount, right? But you have to be comfortable identifying where your weaknesses are. And that's the point of going slow in the beginning and not using real money, not rushing to a demo account. You have to determine where your weaknesses and your frailties are as a person, as a human. And if you don't identify them and develop coping mechanisms and identifying how you're going to behave, how are you going to keep yourself from going on tilt like I was talking about yesterday? How are you going to prevent yourself from blowing the account, from over trading or impulsively pressing the button because you're now in a daze? It's like the fog of war. When you're in trades and you tear yourself down with drawdown, I want to see how it reacts here. I like how it's doing that. Again, I don't want to see it trade above here. It can wick through that. That's fine because we have this order block. It can go as much as the halfway point on the spike of a wick. But I want to see this area here maintain the bodies or resume and send it lower. But the same thing happens to us as traders. When we go through a period of severe drawdown or adversities where you just simply can't find your groove and the markets are hard, that tends to create this fog of war also, where we lose our bearings. We don't really know what we're doing and we're shell shocked. And that's why people in that condition, they go on tilt. They don't have the capacity to think rationally because they experienced horror. That's why you'll argue with your spouse. You'll be more abusive to the people around you and more sharp and pointed with your responses because you view them as another distraction or another way of bombarding you with more stimuli, and you're trying to come to terms with what you just put yourself through. And because you put yourself through it, it's easier for you to associate that as an external thing or something else contributed to why it happened when it's you that did it. All these things, when you look at the potential for the benefits of controlling the outcome, if you could find a way to control the outcome or manipulate it so heavily that an outcome is more likely to occur, because that's my perspective on the markets, that is what I'm thinking when I see one-sided days where they just keep grinding, they don't have any meaningful retracements. So I know I'm in an environment that's highly and heavily manipulated. So I know that the odds of me being, number one, accurate, two, feeling comfortable holding on to the trade, because I know at any time the market could just slip and reverse on me, whether I'm going short or long. And I know that if I get a stop out, it is a realized loss on a day like that. That is like a multiplier that is extremely painful for me. That's a loss that I will beat myself up over. And that's why I tell you, as soon as you understand who you are, you have to bloom where you're planted. Try not to do things that are outside your comfort zone. If I get stopped out on that day, and I have already recognized that this is the type of day it is for me, those are the worst for me. That's the worst type of day for me, because whatever that monetary loss is, and it could be very, very small, in my mind, I will magnify that many times over because I didn't do what I have told myself when I was younger. As soon as I see this type of day, I have to know it, recognize it, and then start taking money off the table, because every single loss on a day like that when I was younger eventually led to me blowing the account, because I was trying to force myself to be in conditions that I was not comfortable in. And then I would make excuses for why this didn't do that. And it was me. It was me that was doing it wrong. And it's a very hard thing to do when you're learning how to do something like this, because everybody wants to be able to fault something externally. You want to be able to say, oh, it wasn't my fault. You can't blame me. No, you chose to put your stop loss there, or you chose not to use a stop loss, and you chose to buy that many contracts. You're making those decisions, and you have to be responsible with that. All of my successful students have gone through this process, but the ones that are successful, they've been very candid about what they see as their personal weaknesses, and they don't feel any shame in that. And that's strength. Well, as a trader, you have to identify where your kryptonite is, and every trader has kryptonite. Mine are internally. I fall on my own sword when I don't identify where I'm at and what environment and climate I'm trading in. He's not even demoing, he's just observing price action. To me, that's the best way of learning. It beats market replay, because market replay is, you already know what it's done. But I mentioned how I wanted to see it could spike up with the wicks up to mean threshold of the order block. So how far can it color outside the line of this gap I was watching right there, which is the midpoint? It trades up to it and then dropped. So we went below this low here. I like that. I want to see it. I would prefer it to go one more time into this. Maybe tap the low of that candle there. It doesn't have to. But right now, I would like to see it kind of like gravitate to these lows and these lows. Larry Williams gave a really funny analogy, and I've borrowed it many times. You walk down this road and you pass this same house, and you see it's there all the time, and they have a dog that's ferocious, and it runs down to bite anybody that comes by and too close to that fence. And you walk by and you make the mistake of walking too close to the fence, and it bites you and tears into your arm. Well, the next day you get up, you walk down there and do the same thing. It rips through the bandages and tears your arm open again. Are you going to do this 50 times before you get the point? Don't do that. I wanted to see where I was making my biggest errors and where it was easy for me to make errors. How can I mess it up? When do I mess it up? What are the types of climates and conditions in the marketplace that were prevalent? They were obvious, that were there all the time when I was creating these hardships for myself. All right, so right now it would need to start falling out of the bed and going lower if it's going to go lower. If it were to rally and go above this short-term high here, now that kills it for me and I'm done for the morning and it kills the session. Now, why would I pull the plug on my interest on this day if it goes above this high? Because we have these relative equal lows here that we swept down below, and it's probably going to keep going higher. I'm not interested in being long today. Now, looking at this day here, today has not been a day that is very easy. It's not clean. It's not a fast running market where it knows it wants to go somewhere. So I'm not interested in pushing a button. I'm not interested in having a hard line decision. Obviously, I want to see it trade down here, but for it to come back up here and create this run through and get that close to that high, what is this? Relative equal highs after it's taken liquidity. So the jaggedness is down here. Where is it smooth? Here. So can it go up here and bump that and then go lower? Can it go above here and then run right through this high? It can. So now think about what you just did. You nodded your head with me as I was saying both. What is high probability trading? The absence of one of them being true. High probability is where it's very, very difficult to frame the other side of the market going against what your trade idea is. If you can only paint the scenario that it's going to move higher and you're trying to be a long, and it's very difficult, next to impossible, to frame any chance that it goes lower unless some freak price move comes in, and that it's not potentially going to occur all that many times, but that always is a underlying risk that it can create some wild price action. Years ago, we used to have surprise rate announcements. We don't see that anymore. And that's another reason why I know the Fed's doing things that he really shouldn't be doing. Everything's scheduled. So that means everything is scripted. But we have not seen anything in here that is quote unquote sexy. There's a interest for me to see price go to certain levels, but it's too muddy. It's too back and forth. But here today, I don't have any interest in being long, even though it could potentially make a higher high here. Again, if I wanted to, let me make the argument that say that I wanted to see it go higher, which I don't care if it does. I don't want to do it if it does go higher. I don't want to be a part of that move. I would have to take a trade based on either half of this down close candle here or touching the top of that one. That means it's got to come back down and hit that. After it's done all this, to do that, that means we could trade one more time back inside this gap. It doesn't make sense for it to do that technically for me. If it's going to go higher, it's done enough here by making these relative equal lows disrupted. But I don't want to be long because it's been one-sided all morning and it just feels like it's petering out. There are times when it'll do these types of things and just keep, like I said, keep growing and grinding higher. And I want to be in an environment that has gyrations up and down, and it's very, very stilted in here. See how it's just like it's being restrained. So when I see price actions showing these types of characteristics where it just doesn't want to do very much, it's lethargic. It runs a little bit, then it comes back in a static, choppy little mess. Then it runs a little bit, and it comes back and does some kind of choppy little mess. And we ran one more time up above that high after taking that liquidity. So I'm walking you through scenarios that don't feel comfortable for me to engage and what becomes problematic, what this may do, where is it likely to go because if it does this or does that. Why won't I take a trade? What prevents me from being interested in the trade? Why something falls out of favor while I'm watching price? Those types of observations when you're first learning, they're going to evade you because you're going to be so fixated on something that's made available to you. Whenever that's distracting you from actually reading the price action, you're actually deferring your greater understanding, and it's divided because you have the personal observations that you're going to feel while you're learning and developing. And also you're trying to also gravitate towards some kind of a approach or model that you're going to stick to come hell or high water, not change, not deviate from. And it's not easy. That's the part that makes it very expensive, not just with me, but no matter what you do in trading, you're going to find that this is it's a truism. It's something that you're going to have very, very sleepless nights and hardships dealing with, and it's uncomfortable, and you're going to want to find a way to get through it and get around it, and you're not going to be able to. You got to go through it. Right, you see that little gap right there, the volume imbalance. Now, because of what it's done here, you want to have this on your chart. That's your daily chart. That is a volume imbalance. And you have to elongate your price chart so that we can see any kind of inefficiencies and things like that. Let's go back into a 1 minute chart. In this instance, I wouldn't want to see this traded back into until it did this move up here. We want to see that remain open and then reach up into that little area right there. There's nothing wrong with missing moves. How do you build your strengths in your model? By identifying your weaknesses as an individual and avoiding those, because then what you've done is you removed the biggest barriers to your progress is going to be you and what you're going to do wrong and when you're likely to do it wrong. This is going to be one of the most not liked live streams, but in my opinion, this is the best one because in the beginning, you want to learn how to make money. You want to learn how to do the right trades, not realizing that the barriers to you getting to that point is knowing the things that we're talking about today. Identifying problematic price action, problematic conditions, when you're not going to do your best. And for some of you, you might thrive in this type of environment. There's a time and place for everything. And what you're trying to do in the beginning is completely unknown to you. And you have to have some kind of a baseline. And avoiding or trying to ignore the barriers to your development or the speed bumps. When you have these moments where the market just seems like it doesn't want to do anything, the energy and the time you spend trying to avoid all the things that you are thinking that you're going to try to avoid, like losing, never having drawdown, only winning, only picking the right order block, only entering at the right time. That is a fool's errand. You're trying to do something that everybody will fail at, myself included. But because no one's sitting down with you when you're trying to do it and trying to coax you out of doing those types of silly stuff, you feel like you're going to be the exception to the rule. And I honestly believed I was going to be that way. You're not going to be. And that's not a knock against you. It's just trying to tell you that instead of trying to avoid the things that are going to be problematic, to try to avoid the things that are going to feel like it's harder than it needs to be, you need to grow into those periods and say, okay, I'm experiencing hardship in reading days like this. I don't know where the market's going to go next. It tends to be choppy and aimless. And then all of a sudden it creates these little runs that come out of nowhere. And then I get excited and I chase that one. And then it pulls back and goes the other direction. That's what I discovered about these types of days for me. They didn't feel right for me, where every decision I was making about trying to engage with it was not correct. And then I would identify early on in the future those same types of characteristics in a new trading day. And the times that I ignored it, I would get hurt and I would draw the account down or do worse. And then I would take that pain that would manifest into physical depression, physical ailments that eventually started affecting my health. I would carry them into new trading days when my model would be there. I'm expecting you to grow a little bit, be a little bit better next week than you are this week. And I know by doing that, by default, you will increase in your understanding. And if you give yourself the opportunity and identify where you don't feel comfortable, that in itself is going to highlight where your model will be strong. If you're profitable, go back and think about the things that you felt that were hardships by identifying them. And if you're responsible and you're mature, you don't try to sugarcoat them or try to hide them from people. If you're going to have a conversation about your trading and your model, you have to be honest and say, okay, this is where my model's strength is, and these are the periods of time when it doesn't excel well. What is it that you're trying to trade on? If you can't draw out on a napkin, what is it that you're seeing before you press the button? And it's shocking to see how many people can't do that. And then they wonder why they can't find profitable trades. Because if you can't articulate in a very simple line drawing what it is you're trying to capitalize on, where your stop loss would be, where's your first target, and where is it trying to go to? If you can't physically draw that out, then how could you possibly articulate or expect to see it in price action if you can't articulate it in a simple line drawing? But anyone that makes money would never look at you and be condescending to you or say, well, you suck. Anyone that does that type of stuff, I promise you they're not profitable. And the ones that make money would have a higher regard and respect for you if you spent time articulating where your weaknesses are as a trader and where your models are weak. Because if you understand where your model is weak, you can do things to manage and avoid those conditions that you have seen and measured by logging and journaling. That's the benefit of doing it. When to sit still? Why does it make sense to sit still? And when does that change? When can we anticipate something that's measurable? When we were trading down here, I wanted to see it trade up into here. This gap offer some kind of a resistance, because then that would have indicated that all of this was built in. It's like a premium. They pushed the price up and trap traders there, and now it should try to retrace to a deeper discount. And remember, I was aiming for this down here. This was my initial, and this is where I still think this is still plausible. May not need to do it today. It could be a response to tomorrow's data. But once we showed this move outside of here and we had this close right there, see how that closed above that? If I had a trade, okay, if we were trading short and I had used this area here as a stop, if it closed here, I would kill the trade. I would save the stop. If it's closing up here, chances are it's going to do what? It's going to come back down here and treat this as support. I'm not interested in being a buyer today. That's what I stated. And I said I would have to consider potentially seeing a stop that would have to go maybe into this gap again. So if it's going to go up, it'll go up just by going into this gap here and reach for this high. And then we went back out to a daily chart, and I show you the volume imbalance. We highlighted it, and it went right to consequent encroachment, the midpoint of that. And look how it's behaving now. Off of a gap here that I said I want to see that stay open. Did it stay open? Yes. It stayed open until we traded up into that daily volume imbalance. What you can do is you can screenshot where we talked about this level in here, and it created that little tiny institutional order flow entry drill. So in your notes, you want to have, whenever there's a fair value gap like that, that low, all it takes is trading one tick below that. And that when it does that, that's an institutional order flow entry drill. How would you use institutional order flow entry drill as an entry? Well, when you anticipate a gap staying open, but you think it may trade higher. So I drew all this out here. And I told you that I want to see this stay open. That means I don't want to see the difference between this candle's high and that candle's low. I don't want to see it trade down like this. In other words, I don't want to see this type of thing. I don't want to see it do that, like come down and completely lay over top of that lower level line. I want to see it can come down into it a little bit, like it does here. Maybe even trade down to the halfway point, which is consequent encroachment. But I don't want to see it trade all the way down into it. So if I ever am watching price action where I'll say I want to see this remain unfilled or left open, it's because I want to see it do this very thing here. And as soon as you hear me say this, you'll hear me say it again, but there are times where I want to see it close in because I want to see it fail. And that's something for your notes too. The inefficiencies that stay open are going to act like real support or resistance because this is acting as a breakaway gap. How do I know which fair value gap won't fill in? Well, we've consolidated like this here, and my attention was around this level here. Not enough to take a trade, but I wanted to see, does it repel this and start to break down? Before I go any further on that, if it would have started the breakdown, I would have dropped down into a 15-second chart, used the fair value gap, and outlined that down into the level I was looking for over here and then here. But it didn't give me that retrace back to it and break down because we're looking at it on a 1-minute chart. Then I could drop down to a 15-second chart and then use that and teach on the price delivery continuum theory. It's basically understanding one time frame and then breaking that run that you see beginning on one higher time frame, in this case the 1-minute chart. I can drop down to a 30-second, a 15-second, a 5-second chart and find multiple entries in that delivery while that price run is unfolding. You're getting lots of opportunities to get involved in that move and still not technically be chasing the marketplace. But there's a threshold at which you got to stop. And if you've seen my lesson on pyramiding, when to stop adding to the trade and making it larger, it's the same premise there. But why did I talk about this staying open before going up into this area here? Because we've traded above the consolidation, all of this right here, all this price action here. We've traded higher since 9:30 here, up, back down, trade higher, consolidating. I don't like these kind of days, and I would rather wait for more information or do nothing, because on a day that's showing me that it's not trying to gyrate around too much, it's small and compressed. It's a lot of stagnant price action. When it does finally move here outside of that range, we had the stops below here taken out, as I mentioned, and then we traded above the high. Okay, wonderful. Once it does that, that means we left this consolidation. Did we lead the consolidation after a stop hunt? Yes. So that means once we're outside of this range, and if we have a fair value gap, those tend to be left open. So what does that mean? You can feel, not today, not on a day like this, but you're going to see me talk about it on other days where there hasn't been a big PPI number or CPI number or something to that effect, where we move outside of a range and we have this same element here. You can go back and look at your old charts and see this here, and you'll see that they stay open, not all the time, but most of the time. If it's something like this and you anticipate them staying open and you have a target up here that you think is going to draw price to, you can put this candlestick's low, your limit order, right at that candlestick's low, because then it only takes one tick to get below it, fill you long, and then aim for your target. Now this is like a bread and butter type setup where it's not a whole lot of movement, not a whole lot of range, but you can see we did trade all the way to the top of that volume imbalance on the daily chart. So this one, for the purposes and exercise of logging it, the whole chart from the beginning of the move down here to the target, and make sure your chart is really filled up. And it's showing you a nice range that we can see the prices over here, and it gives you lots of places where you can write and annotate. When it's open like this, you can use institutional order flow entry drills, which is a partial entry into a fair value gap that you believe strongly is not likely to completely fill in. You will see these setups form, and you will enter with institutional order flow entry drill, as your entry model, just like any other model, any other entry technique. Okay, but it's a very specific element of anticipating fair value gaps that you believe will not close up or fill in like in here. When I was doing Twitter spaces, I'd say note candle at 10:47 a.m. 1 minute basis, NQ. And then I'd say, I want to see that one stay open. That's the equivalent of me saying when we were watching it live down here, I want to see this one stay open. I don't want to see it fill in. And it doesn't. That proves there's logic there. There's something behind what price is doing that's causing me to say those things. It's not me just pulling shit out of my ass. I'm drawing your attention to something that I know with experience will most likely present this. Contrast that with all of everything else that was going on prior. I was in observation mode. I want to see this. I want to see that. Because if it does this, then I'll have more information. I have no hard line fast. This is what it's going to do. Until we had that. Then I said, I want to see this stay open, and we're going to likely draw up into that daily volume imbalance. I'm going to show you characteristics in price action, and I want you to log them. And you're going to see over time, certain things tend to repeat. And the things I'm referring to in price action, you're going to identify on a personal level that it makes sense to you, where other things you may not be all that interested in. And you filter those things out and you work on whatever PD array that you see that is obvious to you. It's jumping off the chart. That means that your concern is around that very function in price delivery. And that is the beginning foundation to your model, your first model. It may not be the be all end all that you retire yourself with. It may not be the thing that you make the most money with. It just means that that's your starting point. So I'm forcing Caleb into fair value gap because that's what I want to focus on. And it just makes it easy. Because if I got to go through this again with him, I'm going to do it where it's more comfortable for me. I'm just going to say, look, I'm dad, and this is the way it's going to be. If we're going to do this, we're doing it my way. For everyone else, default back to what I've said many times in other lectures and mentorship teachings. And the main takeaway is it's allowing you to find the best fit out of all of the things I teach. Which one makes the most sense to you? Because I'm so interested in teaching you every facet to what it is that's going on in the chart and how to focus in on what you should be doing individually, but me having no impact on that. You have to determine what it is that you like. I'm going to walk you through this price run and show you how many examples there are that you could arrive at. So that kind of gives you like a baseline. It's okay, now I know what he's talking about. So now I'm going to start doing those things or start seeing the gravitation towards one PD array. Don't try to force yourself into it because I said I'm forcing Caleb. You might be doing something entirely different. You want to be able to present yourself with that opportunity for you to pick what it is that you see by nature, by the very fact that you're watching price action and I'm commenting on it. When I say those things and the price starts to march to a specific level, and if you see something that I teach as a PD array, I'm probably not going to key up a whole lot of interest around it because I'm forcing Caleb to look at the gap, hence this one running to here. From here to here, that's all I would expect for Caleb. And we waited until 10:52, which is inside the macro for 11 o'clock. There's going to be a run on liquidity or a run to inefficiency. The idea is you want to see where does your attention jump to. Even if I'm talking about price action and I'm referring to something, your attention may go right to something else that I teach, like it's an order block, a stop run here, institutional order flow entry drill. For students of mine that know what an institutional order flow entry drill is, as soon as I outlined the fair value gap, you probably already saw that before I even started mentioning it. But anytime I say a fair value gap or an imbalance should stay open, what I'm saying is this is for your notes. If it's something that's acting as a premium array, meaning that it's trading up to it, which is the opposite of this because we traded up and we're trading back down into it. The most sensitive area in that fair value gap is going to be the midpoint to the high of it here, which is this candle's low. So even if it did trade down into it, if I'm wrong about it not staying completely open and it trades down to the low, it matters not because I'm going to get filled either at that candle's low or just above, halfway in between. My fill will always be in that area. I am never trying to get a fill at the low end. I have seen many times that the market won't go down there, or if it goes down there, it won't fill me because of the spread. So I'm not trying to frustrate myself. So I want to get in with the low-hanging fruit opportunities of entry. That means the easiest one that the spread won't be a factor for. I don't have to demand precision. To me, this is precise enough. Knowing that if I believe that this gap is going to stay open, what am I saying by default? I'm saying that halfway between this candle's low and this candle's high, halfway point, which is consequent encroachment, it's going to go no lower than one tick below consequent encroachment, meaning that I have to find a fill if I'm going to go long, at that midpoint to this candle's low. There's nothing wrong with going one tick as your limit order above this candle's low. That really assures that even if you just book this price low, chances are you're probably going to get filled. Worst case scenario, if it goes one tick below it, then you should have no problem getting filled. But I've been in the market with real accounts with limit orders where the market has spread 2 ticks beyond my limit order and it still did not fill me and it ran without me. So it doesn't guarantee that you're going to get in, which is why I always try to use and teach low-hanging fruit objectives for targets, and the same thing happens for entries. We're looking for the lowest resistance to getting in trade. If we believe that this is going to stay open, Caleb, where would you place your limit order to get in as a buy? You're using that low as your limit order, or are you going to use one tick above it and just feel comfortable with absorbing any of that extra drawdown, being willing to see it trade down to the low, because it could spike down here and do that, still trade up there. But your stop has to be below this candle's high. So the risk is defined by that low is 18,931 even. So your limit order could be 931.25. So if it books at 931 even on that candle, as soon as it does that, it should fill you, but it might not. That low comes in at 929 even. You're getting filled. It's 9 ticks traversing in price. So you're absolutely getting in there. This entry model here, you have to anticipate, expect, and welcome the amount of drawdown that could take place, because it could come down here and touch the low of that. The lower portion of that gap, I'm not interested in seeing it trade down there. But guess what I'm doing? I'm affording myself the flexibility. Should it do so, it would not freak me out if it's a day where I'm willing to be long. Caleb needs to determine if he's going to use the low of that candle when there's a likelihood of a gap not filling and it trades down into it. The best fills are going to occur at the midpoint, which is consequent encroachment, to the high of that gap. And the least probable fill is going to be in the lower half, because you're probably not going to get filled. Why? Because this gap formed after leaving this consolidation. So therefore, this gap should behave as a breakaway gap. It's breaking away from this consolidation. The breakaway gaps, when I'm referring to anything like this where it's not likely to fill, that's your key. That means institutional order flow entry drill. Unless I say that this gap should stay open or unfilled, you're never looking at institutional order flow entry drill. That's not the go-to. Now, let me backpedal just a little bit for the folks that like this idea, because you might think, okay, well, I'm going to use that as my entry technique, even if it's a fair value gap that I may not say I want to see it remain open. There's nothing wrong with that per se. If I'm building a position and say this gap is larger, I will use institutional order flow entry drill as my first entry, 6 contracts long, and it may dig down into consequent encroachment or the upper quadrant, and then I'll add 4 more. And then if I really like what it's doing in there, or if we enter in between, say it goes in at 1047, and then at 1049 it went down into consequent encroachment, and then at 1051 it trades down into 1 tick below consequent encroachment, I'll add 5 contracts on that one. Even though I'm underwater a little bit on the 6 contracts, and underwater maybe a tick or 2 on the trade that I added 4 on, that would be 10 contracts, then I can go in with a 5 lot when it goes to 1 tick below consequent encroachment. With the same assumptions that this lower portion is going to stay open, I've built in a position. The institutional order flow entry drill is more specific to when we like to see a gap stay open. So if it does get below that low and enters into it, the underlying assumption is that you think that the lower half is going to somehow remain open. Some portion of this gap isn't going to be completely overlapped with sell side delivery. If this is not your cup of tea and you can't see that, then you would be trading order blocks. And that would be this candle right there, that candle right there, and that candle right there. All 3 of these candles are all one order block, meaning that this order block is not just the last down close candle before the run up. These 3 consecutive candles are trading back down into this gap that has already been primed to send price higher, and we're just getting one more visit here, and then it trades above it, and it comes right back down and digs into this entire range here. So if you look at it like this, all part of these consecutive candles, that open price is the change in the state of delivery. That means the algorithm sees these 3 candles and goes right to that opening price. What makes these 3 candles the order block is because we have a fair value gap down here, the momentum is shifted higher, this should stay open, trades down and touches the top of it, and starts to move higher away from it. It does so. When this candle's open price, when that is breached, that validates this order block. Think about what I taught you yesterday, or how my entry mechanism was for the initial entry in 6 contracts short. The same logic is being shown here, just reversing it. Now, look at that opening price through all of this back and forth price action. When you have this opening price, you want to extend that to the right and then study how price respects and deals with it. The wicks are always allowed to do the damage, but look what the bodies are doing. The bodies are staying in the upper half of the bodies. The bodies tell you the narrative. So if you take that range, we have the body on the open down to this close on the lowest down close candle. That range is where the narrative is going to be seen. If this is an order block, these things I'm going to show you right here, they're going to be present. Extend that forward. The body stops right there at that open. But what does the wick do? Trades down. This candle's an up close. It doesn't matter. This candle trades down into the open plus a tick or two and then trades higher. Then we trade down again. It sends the body into the upper half, that red line. Look at what's going on there. Any down move back into that range, where are the bodies? They're in the upper half. So you don't have to sweat picking the best entry. If you know what my order blocks are, so the opening price, extend that through, you can see all the bodies are working inside that, but the wicks are allowed to do the damage, but they're never piercing the body's low. See that? And then over here, what time is that? 11:10. What do you think's happening right there? The algorithm. It opens, it sends the price down into that opening price right there. But that opening price, that's the sensitive price point. And that's the change in the state of delivery. Meaning that right there, any return to that price and or into the upper half of that consecutive down close candles, but you can't deny that right there and the time it's forming, because it's all time. So here is the first trade and delivery inside of the fair value gap. This is the PD array. At 1050, the algorithm will do what? It will seek inefficiency or liquidity. Okay, well, we have a gap. It could act as a breakaway gap. We expect it to trade down into it, but not fill the gap in. What time is that actually occurring? At 1052. Does it meet the criteria for a macro? Yes. So the time this is forming, it meets it. So that means the market should start to gravitate where? To liquidity, here, and where I took you to the daily chart. Because if the market's going to move, it's going to move to something on the daily chart. It's not just 1 minute charts. There's got to be some kind of higher time frame premise. Then if you build that in relationship to what you see on the smaller time frames, you have the best of both worlds. All of the things that make the world go round in the financial market, the key premise and levels are going to derive from a daily chart. It's the previous day's high and low, the previous day's high and low in the last 3 days, last week's high and low, the upper quadrant, the midpoint, and the lower quadrant of that range. Those are always the levels that you need to have. These are reference points that the algorithm will always go back to. If it's running on an algorithm, those are your key reference points. But here's the 1050 to 1110 macro. Every hour. At the top of the hour, the market will jumps and runs to one of two things. It will go to a short-term low to tap into liquidity, or it goes up to a short-term high, or it trades to an inefficiency to invite smart money to capitalize on an entry right before price spools to the liquidity. The inefficiency I identified as it was forming, I said, I want to see this stay open, and I drew your attention to that volume imbalance on the daily chart. That's all you need for a trade, folks. You don't need to be in it doing all this. But remember, I was telling you like how it's just going to keep marching around. These are days that you're going to get beat up. So if you get one victory, one little win, and you identify a day like this, a hard read, take it and leave. And don't regret it. Don't even look back at it. But it's occurring at 1052. It's trading in that inefficiency. For what reason? It's going down there to offer fair value. Then where does the market trade to? Liquidity, which is that high here. Because when it drops down here, the highest high prior to that is here. But what's above that? What I took your attention to on the daily chart, that volume imbalance. So from this candle's low to this candle's high for the buy side, 5150. So we have 20 handles. 20 handles, that's enough to do a trade for like a bread and butter type sec. To give a better range, that volume imbalance that's shaded in yellow that I got on the daily chart, the low of that, we'll just ballpark it, that's 56. It's 15 handles, consequent encroachment. So we're looking at 30 handles thereabouts to get to halfway point, which is right up here. And that's exactly what I said. I would only expect that from Caleb. Being a buyer down here, should he felt inclined to do so, and getting out at midpoint here and maybe getting filled here eventually, that would be the trade, and then he'd have to move to the sidelines to be content with it. The fact that it's a PPI or CPI number today and it's doing these type of behavior, I'm not personally interested in taking those types of trades, even though there are some elements that I can pull out and say, well, here's a setup and let's watch this. but I'm not going to push the button. There's lots of things all day long, but I don't feel like I'm missing anything because I know how to find trades tomorrow. And that gives you confidence. So at 10:52, we're trading inside the time. That means every hour a macro is in operation, every single hour. Some macros are better than others. I've talked about most of them already on Twitter Spaces and or other videos on this YouTube channel. There are times where you want to be using them and others you just want to sit and wait, and this would be labeled on your chart. And what we've done is we've highlighted a time when the algorithm controls price and nothing happens outside of its control unless it's a manual intervention, and you'll know when an intervention is there because it's just completely abrupt. Manual intervention is FOMC. That's always going on. Every single time FOMC comes out at 2 o'clock and at 2:30, both of those things are manual intervention. They're absolutely controlled demolition. But at 10:50 for the hour at 11 o'clock, 10 minutes before 11 and 10 minutes after 11, that's a 20-minute interval. The market will seek either inefficiency, like this gap here, or it will seek liquidity. Say, for instance, we didn't have this gap here. If that's the case, then what you would do is you would wait for the down close candle that forms in any retracement here. It has to run away from it and then come back down like we're teaching this order block. That would be what you would look for. But if there's no inefficiency, you have to use the order block. So either it's a gap or an order block or a short-term low. So there is no short-term low in here until that forms. But what's there? The inefficiency. There's no condition that has all three. You're not going to get a short-term low, an order block, and a fair value gap. That can't occupy the same space in the time frame or chart you're looking at. It's physically impossible. It's two at best, but never all three. But usually it's one or the other. So there's no short-term low to be worried about trading down below. We do have a gap, but it happens to form after a breakaway from all the consolidation that we were monitoring and I was not interested in all morning here. And I mentioned that we had these lows down here. We swept below that. And I said, okay, I believe that they're going to use the fair value gap that I mentioned here as support. They didn't really technically touch it at all. It was like one tick away, but it then displaced above the high. This gap forms after that breakaway from that consolidation. So at 10:52, we have our first piece of information. Yes, price did trade down in there. Yes, it did not fill that lower portion. And any subsequent touch of the fair value gap high can be used as support. It should be immediate response, take off and leave it, and trade to that high. But how far above that high can it go? You got to go to a higher time frame reference point, which is why I took you to the daily chart to highlight this volume imbalance. It was the easiest, obvious level above this high that's inefficient because there's no way to classify short-term buy-side liquidity on the daily chart because you have to go further up. So what's the first PD array that you'd come to on the daily chart? It's this shaded area that I highlighted, which is the volume imbalance. So from entering here at 10:52 into this fair value gap, you have all the way up to 11:10 to see any new entry. So all through this period from here to here, relative to time, this is a time window. In other words, this is what you're saying. In price action, there's going to be opportunities to be a buyer at a discount array. What discount arrays do you see? Institutional order flow entry drill inside this fair value gap that should not fill in because it's a breakaway gap. Why? Because it left the consolidation. Then we have this down close candle. Does it repel price after? It does. Does it trade above the opening price? Yes, that validates this down close candle as an order block. Is there any down close candles prior to that candle, immediately to the left of it? Yes. Is there one prior to that one? Yes. Is there one prior to that one? No. So algorithmically, the price is called to that opening price because it's the highest portion of these three consecutive down close candles, the opening. That's the change in the state of delivery. You extend that through time. How far do you do it? All the way till 11:10. Trades right back down into that opening price. Bang. Then it delivers higher. If you're trying to get on board and you're trying to work with a macro, because a macro, that 20-minute interval is like a supercharger for efficiency and immediate responsiveness in your entries. That's not to mean that you can't take trades outside this. I'm saying that if you focus on these elements of your setups, you're going to get the better fills. You're going to get the immediate response by price telling you, yes, you're on side. How do you know you're on side? When the market immediately starts moving away from your entry and never getting close to your stop. That's a wonderful feeling. How do you get into trades that promote that as a steady diet? Time. Time is the most critical function in price delivery. But the point is you have the down close candle here that we walk through the sequence of guidance tells me that if this is an order block, the way you determine is there a down close candle prior to that one to the left? Yes. and it does it here, yes, and then you don't have it here. So you use the opening price there. That's all their algorithm's doing. Buy time, touched here. Why? Why is that important? Because this is the framework that causes that inefficiency. This is where we traded to the low of. To get this fill perfectly, it's got to offer one tick below it, and that's why it goes down there. When we look at price like this, every hour, you should have an alarm. So it tells you, start looking for a run to gaps or inefficiencies or trade to liquidity. Which one do you do? Right here at 1050, that's the beginning of the macro. What occurred right there at 1050? We've already taken out relative equal highs. So we are engaging liquidity. What kind of liquidity? Buy side. There's a more likelihood of price going higher at that moment or going lower. We have the short-term low that it forms and then trades higher once more. So we have buy side once more. The inefficiency below the marketplace is where? It doesn't exist in here. All this run up to that high, there's no gap there. All of it's laying over top of each other. This wick here goes back to this low. So there's no inefficiency there for the 1 minute chart. So what does it mean? Sell side if it's going to go discount to here and or what's that daily inefficiency that's in yellow? That volume imbalance. We went down to it here. We rallied back up, traded down, one more higher high, and then digs all the way back down. What time? 12 o'clock. So that's mid macro, entering the last half of that 20-minute period. So if it's going to be reacting off of that, and if price is bullish, where would it go to at that moment? To a inefficiency above that. So where's that at? Not here. It's basically overlapping there. You have this one, which is a volume imbalance, which is a smaller form of what this shaded area is that's derived from the daily chart. So you can trade up to that. It does that handsomely. It does this one here again handsomely. And you have all of this here. It trades up to that there. And then you have the liquidity above that high. You just drop down to go into an area, then start going back up. So you have to look at that surface of that rock, like a rock climber, and say, okay, where's my footholds? Here, all of this inefficiency. How can this inefficiency be used as a foothold? It has to go above it, and then come back down in here, and then sends price higher again, taking out this high. So price is using this time to refer to key price points. And if you are looking for a directional run, it helps you frame that. Every single hour, it does this. 90 minutes. That's the smallest window of your trading time. Anything less than 90 minutes, you're not giving yourself a fair chance. Because what that does is it guarantees you're going to get one macro. Knowing what the price is likely to do, because you understand how to read price, and you also understand a directional draw on where the market may send price. That means, what do you think the daily candlestick's going to do? What do you think the session's going to do? What is the weekly chart reaching for? Incorporating the higher time frames, weekly and daily, you get much more information, which makes your trade decisions a lot easier and better. So you can see how these elements of time, they're crucial. They are superchargers for anticipating price runs, and how they are to behave, how they function. What's the mechanics behind why a price run takes place? This is my life. This is my passion. It's my baby. I want to brag on it because she does exactly what she's told to do. And there are times where it can be messed with. It can be disrupted. And when you see those types of things and you understand what it should do and it's not doing that, that's the clearest thing I can say that tells me I'm not doing something in the market that day. So if it's telling me very clearly that it's trying to do something based on time first, it's reaching for a pool of liquidity or inefficiency above or below the marketplace, then it's going to keep doing that. And either I'm on a trade or I'm not going to be on a trade. And if I'm not going to be on a trade, I don't care. All of this price action, these types of runs here, they're not interesting to me. They may be fascinating because I'm outlining it to you and why the things happen and how it all stems from that first run out of that consolidation from earlier in the day. But there'll be certain aspects to it that I can see that are synonymous to what we look for algorithmic trades. Look at the difference between 1050 and 1110. So in between these two vertical lines here, the purest, cleanest delivery, the real runs start in there, and then after 1050, price can still advance, but look how shitty it gets. All of this, and then suddenly what happens? The algorithm starts going back into what it does, following its code. At 1050, 10 minutes to 12, we get run on liquidity, back down into a discount, sell side, run. This isn't the most obvious examples, but even on a shitty day like this, you can clearly see something's going on between this time window of 20 minutes. I want you to study your charts like that. On a 1 minute chart, on a 15-second chart. Now, you do have a midnight to 1 o'clock in the morning macro. You do have a final hour of the day, 3 macros. I've talked about them for indice trading. If you have a general idea where the market's likely to go. That's the first and foremost lesson, though, which is why I've been beating it into everybody's head, knowing where the market's trying to gravitate and draw to. If you don't have that, everything else is going to put you offside and you're not going to do well and you'll be frustrated. But once you understand where the market's likely to draw to, and it has range, what's range? It's got to at least be able to move 20 handles, because at 20 handles, I can get 15 handles or 10 handles from that. If I'm not confident that I can see a very simple price run of 20 handles, it's going to be one-sided, it's going to be timeable, where I can go in and anticipate it occurring, then I'm not interested in taking the trade. And I don't care how it trades and keeps moving and moving and moving. I don't care about that, because I know that there's going to be technical days that's going to be like this that I don't care too much about. If you're looking at this as a basis of finding when the moves begin, this is one of the easiest ways that you can frame out your hindsight moves and start studying them. And then by going through the process of reading all this stuff, notice how candlesticks in and of themselves that are down close candles, if order flow is bullish, for the sake of benefit of hindsight it's available here, obviously the market wants to go higher, and we can see that it's done so. But where are you keying up your interest in this? Because if you're trading outside of the 1150 to 1210 and 1050 to 1110 intervals, you're demanding that you know a whole lot more than you probably do in your skill set. What I do is I'm putting your focus inside of these specific windows of time where the setups will absolutely fucking be there. You might get the direction wrong because you have not done enough work into determining where price will be gravitating to. There's a certain measure of responsibility on your part. Like, you still have to go back to square one, which is, where is price being drawn to? If your models don't start with that first foundational premise, everything you do after that or apart from that is likely to fail. And you won't have the courage to stick with any trade idea, because any little fluctuation and return back into this rally up, these are all ugly retracements. I don't like price activity like that. I like price action that has none of this shit in it, where it runs and creates very obvious one point of inefficiency, a fair value gap, a buy side imbalance, sell side inefficiency, or a sell side imbalance, buy side inefficiency. It's easy for me to read that. It's very, very easy to do that. And my students that know how to read the price action and the things I've taught, they can nod their head and say, yep, that's all I do. If you're going to trade in environments like this, you're going to do something I'm not interested in. Nobody gives two shits about wanting to trade in this kind of mess here. Nobody's going to put lipstick on this pig and say, how pretty is that? I like a swing trader's environment in intraday, because I can buy and sell, go short, go long in the same trading day, in the same trading session, in the same hour. So if I can't do those types of things, that's usually an indication that I'm probably not in a market environment or a session that is conducive for me to be comfortable. But I'm practicing what I preach and what I live by. If it's a condition that I don't like, I'm staying out of it. The learning curve is shortened by you learning initially how you're going to probably mess it up. And 90% of those things are you yourself. You're the catalyst that causes those things. It's you doing things that were not taught to you. You're trying to reinvent it, trying to do something different, or you're not following the rules at all. And if you can't do those two things, you can't reasonably expect to be able to be productive and profitable in your learning, or eventually being profitable in terms of making money. The sooner you warm up to the idea that you're not expected to be perfect and you don't have to trade every single day, that is such a very liberating frame of mind. As a constant reminder, before you start trading, you should write it down in your pad and remind yourself, if it doesn't feel right, and if it doesn't look right, and if I don't recognize it, I don't have to trade. So I want to focus where I shine. I want to be visible when I know I have all of the things in my favor. And if I choose to operate all my trading like that, that refines you as a very mature, principle-oriented investor and trader. That means you're not out there just pushing the buttons for the sheer gamble and thrill of it. You're weighing out all the ramifications of your decisions. Because if you have a model that you're following, it's going to have certain measures of criteria like we're talking about here. There has to be something that frames a day that you are not allowed to touch. Should you be in there engaging and studying price every day? Absolutely. And if you can't let the market pass you by and you feel like, man, I'm missing so much, that's highlighting impatience and greed. And those two things together, they're deadly. And you have to master them early. And that means by watching price and giving yourself permission. I'm not going to try to trade. So here's the volume imbalance I took your attention to earlier. We've traded to that and through it. This up close candle right here, you want to measure that. So that's mean threshold. So 19,255. I'm not saying it's going there, but let's just say that it wants to keep going higher and go beyond previous new week opening gap, which is high, that high here. You see it right there. Where we stop trading, that's a level to look for to trade to. And then the middle or mean threshold of that up close candle prior to that drop down, that midpoint right there. Now, if we start exploring anything above that 255 level, then they're going to want to run this high. And where does that leave us? This right here. That's a huge disparity between where we closed here and where we opened there. That's a huge gap. So longer term, if they want to pump this up, and it can happen because it's an election year, barring anything really catastrophic taking place over in the Middle East, it would be reasonable to see it want to take this high and maybe even go up into this area here. But I'm not demanding that. I'm not holding for something like that. Without any real bad news, without any mushroom clouds popping off, they're going to try to keep pumping this up because it's in their vested interest to make it look like the economy's good. And volume imbalance here, that would be the highest extreme for this year at the present. Right now, looking at the chart, if it were going to go up from where we're at now, any higher, the highest that I would want it to go to and feel comfortable and reasonably expecting it to do so would be that volume imbalance right here. This is all based on the fact that we didn't see anything pop off with Iran and Israel to a greater degree. That's what this is. This is kind of like a relief. It's just being organized in sentiment that, okay, everything's safe right now. Does it stay that way? Who knows?